Welcome to the Suntrust third quarter earnings conference call. All participants will be in a listen-only mode until the question and answer session of the conference. At that time, if you would like to ask a question, you may do so by pressing star, then 1, and recording your first and last name. This conference is being recorded. If you have any objections, you may disconnect at this time. Now I'll turn the call over to Ankur Vyas, Director of Investor Relations. You may begin.
Thanks, Christine. Good morning and welcome to our third quarter 2014 earnings conference call. Thank you for joining us. In addition to today's press release, we've also provided a presentation that covers the topics we plan to address during the call. The press release, presentation, and detailed financial schedules can be accessed at investors.suntrust.com. With me today, among other members of our executive management team, are Bill Rogers, our Chairman and Chief Executive Officer, and Aleem Galani, our Chief Financial Officer. Before we get started, I need to remind you that our comments today may include forward-looking statements. These statements are subject to risks and uncertainty, and actual results could differ materially. We list the factors that might cause actual results to differ materially in our SEC filings, which are available on our website. During the call, we will discuss non-GAAP financial measures when talking about the company's performance. You can find the reconciliation of these measures to GAAP financial measures in our press release and on our website, investors.suntrust.com. Finally, Suntrust is not responsible for and does not edit nor guarantee the accuracy of our earnings teleconference transcripts provided by third parties. The only authorized live and archived webcasts are located on our website. With that, I'll turn the call over to Bill.
Thanks, Ankur. As usual, I'll begin this morning with a brief overview of the quarter, and then I'm going to turn over to Aleem for details on the results. So following Aleem's comments, I'll wrap up our prepared remarks by reviewing our performance at the business segment level. Earnings per share for the quarter were $1.06 on net income to common of $563 million. However, as previously disclosed, we recognized a $130 million discrete tax benefit, which we returned to shareholders through a one-time share buyback. Excluding this gain, earnings per share were 81 cents on net income to common of $433 million. Our adjusted results were in line with the previous quarter and up 23% from last year, reflecting solid loan and deposit growth, further efficiency improvements, and continued strong asset quality performance, all of which helped mitigate the impact of the persistent low-rate environment. Our adjusted revenue was up 3% year over year, but declined 3% from last quarter. The sequential decline was primarily a result of our investment banking business rolling off record results in the second quarter and the loss of some investment management income due to the sale of Ridgeworth. Net interest income was generally stable relative to both periods as solid loan growth mitigated spread compression. With regard to non-interest income, as we said before, several of our fee-oriented businesses are subject to some seasonality. With that in mind, I believe our year-to-date fee income performance tells a more accurate story of how we've been able to leverage our investments in these businesses to drive more consistent execution and deepen client relationships. Our non-interest income, excluding the impact from Ridgeworth and mortgage-related revenues, was up 7% year-to-date, with meaningful improvement in investment banking, retail investment services, and traditional private wealth. These positive trends, combined with higher mortgage servicing income, help offset the 60% year-to-date decline in core mortgage production-related fees. Expenses declined relative to both periods, previous quarter and the prior year, and notably, our adjusted tangible efficiency ratio was 61.9% for the quarter. That brings our year-to-date ratio to 63.5%, and keeps us on clear track to deliver on our 2014 sub-64% efficiency ratio commitment. Our performance this quarter demonstrates our continued focus on efficiency improvement, and importantly, our steady progress towards our long-term target is evidence of our methodical transformation to a more efficiency-conscious culture across the company. So looking at the balance sheet, period-end loan balances increased 2% sequentially, led by growth in C&I, traditional CRE, and our consumer direct portfolio. However, average performing loans were flat as a result of the $2 billion guaranteed residential mortgage loan sale this quarter. Average client deposits grew 1% relative to last quarter, with favorable mix shift continuing. We've built positive and broad-based momentum across our lending platforms and are focused on ensuring our deposit growth keeps pace. Our credit quality performance continues to be strong, and in the quarter we were able to further improve the overall asset quality of the balance sheet through targeted non-performing asset reductions. As a result, NPLs declined 15% sequentially, and net charge-offs ticked up slightly to 39 basis points. Finally, our capital position continues to be strong and was relatively unchanged from last quarter, with Tier 1 common estimated to be 9.7% on a Basel III basis. So with that as a quick overview, I'll turn it over to Liam to provide some more detail on the results.
Thanks, Bill. Good morning, everybody. We're glad you were able to join us at our slightly later start time this morning, and we're pleased to be able to accommodate those of you who needed to watch Thursday Night Football last night. Earnings per share this quarter were $1.06, and included in that result is a 25-cent benefit that we recognized upon the completion of a tax authority exam. Excluding the impact of this benefit, adjusted earnings per share were 81 cents, which was in line with the previous quarter and 23% higher than the third quarter of last year. The year-over-year increase was driven by 3% adjusted revenue growth as a result of higher mortgage servicing income, a gain on sale of mortgage loans, which I will discuss later, and slightly higher net interest income. A 3% reduction in adjusted expenses also contributed to the year-over-year improvement as we continued to execute on our efficiency initiatives and benefited from lower cyclical costs. These positive trends more than offset the $45 million year-over-year decline in trust and investment management income resulting from the sale of Ridgeworth. Sequentially, earnings per share were flat, as a decline in non-interest income and modestly higher provision expense were offset by a 5% reduction in adjusted expenses. Lastly, adjusted year-to-date earnings are up 19% compared to the previous year, as solid balance sheet and fee income growth, lower expenses, and improved asset quality have more than offset the $205 million reduction in core mortgage production income and 14 basis point net interest margin compression during that same time frame. We'll now review the underlying trends in more detail, starting on slide 5. Net interest income was generally stable relative to the prior quarter and prior year, as loan growth negated loan yield compression. Net interest margin declined 8 basis points sequentially, primarily due to a 7 basis point decline in loan yields. The decline in loan yields was most notable in our C&I book, though we also felt this to a lesser degree in our commercial real estate and indirect auto portfolios. The drivers of our loan yield compression are mix shift, as wholesale is growing at a faster rate than the rest of the portfolio, and continued competition in our markets and businesses. While loan yields in the wholesale segment are typically lower, C&I business often brings with it additional non-interest income and deposit revenue. Our intent is to meet the full suite of our clients' needs and maintain a disciplined focus on entire relationship returns. Securities yields declined 9 basis points sequentially, primarily due to higher prepayments, as MBS cash flows increased into our investment portfolio. On a year-over-year basis, net interest income was relatively flat, as solid 6% earning asset growth neutralized the 16 basis points of margin compression. Overall, the net interest margin has declined in 2014 more than we had anticipated at the beginning of the year, as commercial loan growth has been stronger than expected and yields continue to compress. Looking forward, we expect fourth quarter net interest margin to decline approximately 3 to 6 basis points from the current level, primarily driven by lower commercial loan swap income. We have been and will continue to carefully manage our overall balance sheet duration and utilization in light of the continued low interest rate environment, while also being cognizant of controlling interest rate risk in advance of what we expect will eventually be higher interest rates. Moving on to slide 6, adjusted non-interest income declined $72 million from the prior quarter, driven primarily by lower investment banking income and the loss of investment management income from Ridgeworth. Investment banking declined due to the strong performance in the prior quarter, seasonally lower client activity this quarter, and transaction timing. Year-to-date, investment banking income is up 14%, with syndicated finance, M&A, and equity offerings being the primary drivers of growth. Trust and investment management income was down $23 million sequentially. However, Ridgeworth represented $31 million of the decline, and our core private wealth business grew $8 million. Mortgage production income was down $7 million quarter over quarter, as gain on sale margins declined slightly. Closed loan production increased 11%, while applications declined 4%, reflecting the return to more normal seasonal patterns in the mortgage business. Retail investment services and card fees continue to be on a positive track as a result of our ongoing focus on meeting more clients' needs. In addition, service charges for deposits increased $9 million, partially driven by seasonal trends. Other non-interest income, excluding the gain on sale of Ridgeworth, declined $13 million as a $41 million gain related to the $2 billion sale of government-guaranteed mortgages was negated by a $49 million impairment of a leasing portfolio due to market-driven declines in residual values of certain assets. Lastly, we incurred $9 million of net securities losses in the quarter due to a minor repositioning of the investment portfolio. Compared to the third quarter of last year, adjusted non-interest income increased $40 million, driven by higher mortgage servicing income. Finally, to echo Bill's previous comment, year-to-date non-interest income, ex-Ridgeworth and mortgage-related revenues, was up 7% year over year, which reflects the positive momentum we're creating in our CIB business, as well as retail investment services, core private wealth, and credit card. Moving on to expenses, adjusted non-interest expense declined $71 million or 5% relative to the prior quarter. Personnel expense was down $33 million sequentially, driven by the sale of Ridgeworth, a reduction in FTEs, and lower benefits costs.